Hello everybody, welcome once again to the weekly wrap-up from forexlivetoday.com of the Forex markets. And today we'll actually be looking at some of the other markets just so we can see the correlation and the importance of understanding what all these markets mean to our trading. So let's get started. The first chart that we are often looking at recently is the S&P 500. And as you can see, we had a big move down this week, especially throughout the latter stages of the middle of the week. So just to recap, we started out the week with a gap down due to, which you can see here, with a gap down due to, once again, the EU, not really coming up with anything, basically. Just a lot of talk regarding Greece and their bailouts. But the big mover really was the Fed, and after their September interest rate decision, the statement that came along with that, which talked about significant downside risks, but more importantly than anything else, basically admitted that throwing money at these markets and outright asset purchases has failed. And they didn't actually say that, obviously, but what they did say is moving forward they're going to be selling short-term debt to buy long-term debt. Now the reason they want to do that is they want to flatten the yield curve, which means long-term interest rates should come down while they will allow short-term interest rates to creep up. So if you can imagine the curve there, it will be flattening out towards the longer maturity loans. Now, this means people's home loans, car loans, student loans, things like that will become cheaper. So instead of putting the money into the hands of bankers, they're trying to put some money into the hands of consumers. Now, as a long-term strategy, yeah, you might say this is probably pretty good. Now, but we're traders, so we want to know how the market reacts. And you can see the market was, let's say, disappointed with the news that there will be no further, outright stimulus or cash injections directly into the markets. So Wednesday and Thursday, and almost into Friday, but Wednesday and Thursday were the big moves down. Once again, we came from the top of this range, the 50% fib, and moved straight back down. However, even with all this negative sentiment, we did not break this range. So that's how the equity markets are looking. Now, if we bring it across to our currencies, we've been talking for some time how we have our safe havens of, let's say, the Swiss franc, Japanese yen, and the US dollar. Now, they all play slightly different roles in terms of safe havens. Now, we know recently the Swiss National Bank has stepped in to put a peg or put a target price on the Swiss franc. This has removed the safe haven status of the Swiss franc a little bit and turned it more into a funding currency. The same as the Japanese yen. Now, the US dollar is a safe haven in terms of liquidity. Now, the sovereign debt crisis in Europe is not getting any better, and this has been going on for over a year now. So the politics that are involved has done nothing really but just hinder any kind of way out of this. They've dithered, they've kicked the can down the road, they've thrown short-term solutions at it just to put it off for a little while, injections of liquidity. However, it's not worked, has it? And here we are again, a year later, basically at a precipice, at the edge of the cliff. So let's see how the US dollar performed this week when we have a risk aversion move, but not just a risk aversion move. We have a risk aversion move tied in with, liquidity issues, possibility of a credit crunch. So let's look at the euro dollar, and as you can see from our daily chart here, the euro dollar has sold off once again this week. We broke this range a long time ago. We're distinctly bearish. However, if I scale out on this chart, you can see we are once again at a significant support. So if we flick back again to our S&P 500, you can see the support here, and on the euro dollar the support here. So although yes, we're in a bear market, yes, these moves are very bearish, and overall we probably are bearish, you've got to be careful. There's going to be bounces, there's going to be corrections, there's going to be headlines where this is going to move up. So if you're bearish, if you're looking to enter short, obviously now is not the time to enter short. You want to enter short on a break of this, or you want to enter short on something like a 50% fib. So perhaps up around this level at 139.75, something like that. Even a 61.8% fib. Don't like the chances of it getting up there, but if it did, 141, these are the type of entries you're going to be looking at. Alternatively, if it just does continue straight down, you've got the break of this support, which can lead us to significant downside. You can see from the chart here. Pound dollar, same story, exactly the same. Extremely bearish, even more bearish than euro dollar, which was quite surprising to me. I didn't see this big move, the strength and the real depth of it coming, to be honest. But once again, it's happened, and we're down here at this significant support level. Exactly the same story. Draw the fibs, wait for the bounce. If you want to get short, look for these key levels to get short, or you can wait for the break of the support. Now, something else I want to talk about. Recently, there's been a lot of talk about gold being an alternative currency, or gold being a safe haven. So in this week where we've had a really strong risk aversion move, gold should have gone up, right? Wrong. Look at this. This daily candle here is the biggest daily candle for, you can go back a long way in the chart and you won't find a candle like this. Why is gold moving in the same direction as equity markets? If people are, fearful, if they need a safe haven, why are they not buying gold? Well, the people who buy gold are investors. So it's the same people who invest in equities who invest in gold. Often it's used as a hedge rather than as a straight out safe haven. So when people are making losses on their equities, they need to sell some of their profits to get their hands on that cash. Gold is traded in US dollars. Once again, when you have strength in the US dollar, money coming out of gold exacerbates and you get these moves like this. Trading gold, extremely volatile and risky. But as you can see, these correlations, if you logically think them through, it's all very clear. Okay, focusing on some of the other major currencies, we have dollar yen. Dollar yen again hugging the bottom of this range. As I've mentioned for weeks and weeks and weeks, 76.30 is the floor that I've put in, and it's bounced off there a few times this week. I see no reason to change that. Entries at 76.30 for short-term profits, holding for the medium term, it's up to you. Dollar Swiss. Now, once again, we've seen how and talked about how the Swiss franc is heavily manipulated at the moment, but you can see this week with this liquidity, need for liquidity and strength in the US dollar, it has moved up. This was after last week moving down to test the the level of the original move after the announcement of the peg. There is nothing to stop this coming back. So if more money starts coming out of the euro, it could go back into the Swiss franc. And remember, the Swiss franc is pegged, or the target level is aimed with the euro, not the dollar. So there is the possibility for this to move back down further. Okay, a couple of other things to look out for, especially in a market like this, and to prove these correlations once again. Aussie dollar, US dollar. As you can see, it's almost, you can see it looks like these moves that we've had in the equity markets, it's almost the same. This is how closely correlated the Aussie dollar is to risk trends. When you have a risk aversion move, the Aussie dollar drops. People sell the Aussie dollar, even though the Aussie dollar still has an extremely high interest rate compared to other currencies. This is what's happened. Now, if we zoom out from that, you can see two significant trend lines here. So you want to get short in the Aussie dollar, maybe you've missed this first move, you get a retrace up to this point here. That looks like a beautiful point to go short there. Aussie Kiwi. If you're looking for something to keep you totally away from the US dollar, away from risk trends altogether, this is something to look for. Aussie Kiwi, both of them have very similar risk profiles. So when you have a risk aversion move, they're not going to move one way or the other based on that. They're going to perhaps respect technical levels. And when we respect technical levels, we have a really strong, gentle uptrend here. So perhaps position from here to the upside. Finally, another one to keep you away from US dollar. If you're already short, the euro against the dollar, if you're already short the pound against the dollar, you're already long dollar. You don't want to be opening up all these positions long dollar. So look for these alternatives. Here's another one, euro pound. Again, similar geographical and economic situations. Both got interest rates coming up in a couple of weeks, so we'll talk more about that next week. But for now, stick to the technicals. Nice upward sloping trend line here. Don't try to overcomplicate things. So this week there has been lots of money to be made if you just logically think things through, look for the correlations, look for the levels to go, look for some support, things like that. Good luck out there. I'll see you all next week, and bye for now.